Hello, I'm gonna be doing the session 12 assignment. So let's get straight to it. Session 6 assignment, or session 12 of section 6. Assignment comprehensive business evaluation. Assignment overview. Deliver a full evaluation of Panera Bread for a prospective KKR takeover using driver, combined DCF trading comps, and precedent transactions to produce an informed bid range while contrasting financial buyer discipline with strategic buyer synergies. So the deal snapshot is of scale of 6 billion revenue that's growing 8%, 900 million EBITDA with 15% margin, 400 million net income across 2,100 stores, digital sales already 50%, market reference is industry PE to 22x, precedent EBITDA multiplies 12 to 15x. Chipotle trades at 35x PE. McDonald's at 25x. Capital assumptions. Industry WACC 9%. Management wants 10% rollover. Strategic bidders. Starbucks, McDonald's are circling. Growth levers. 500 new stores in 5 years. Digital mix to 70%. Dinner, catering, expansion. Early stage international rollout. Create an executive ready recommendation that states your evaluation range, winning bid strategy, and rationale for choosing financial versus strategic positioning. And if we get straight to it, we're going to start with the define and discover. So the objective is determine the value of maximizing bid range for Panera Bread under the disciplined lens of a financial buyer and contrasted with the value evaluation justified by strategic buyer. So the key facts that were given is the revenue for Panera Bread with 6.0 billion dollars with 8% growth, the EBITDA of 900 million with 15% margin, net income of $400 million. The stores, there's 2,100 stores with digital sales roughly equaling 50%. Financials is WACC's industry 9%, management rollover 10%, market references. Industry PDE is 22x. The present transactions is 12x to 15x. EV or EBITDA to public comps, Chipotle 35x P&E, McDonald's 25x P&E. So some questions that we could consider are what is the defensible EV range for KKR without relying on aggressive quantified synergies? How much incremental value can a strategic buyer justify through scale and cost synergies? What is KKR's disciplined walkaway price represent with discounted cash flow, which has a projection of 5 year explicit forecast, inputs of FCF built based on project growth, projected growth, margin expansion, and cap EX. Discount rate WACC 9%, the terminal value with the growth rate at 2.5 to 3%. And then the trading comparables with peers, fast casual. The metrics translate industry applies to Panera's LTM net income. The precedent transactions anchor uses the 12x to 15x EBITDA range as a historical anchor for control premiums. The synthesis combine results into a football field diagram to usually define the bid range and walk away price. So some implementations that we can do is revenue growth with 8% with 15% of the EBITDA to 16.5% by the fifth year. The D and A of 3.0 percentage of revenue, CAPEX of 4.5%, NWC of 1% of revenue, and then there's a tax rate of 25% as well. And then we can see this little table with the different scenarios. So for the base, some key assumptions would be a 1.5% margin lift and 8% growth, and then the implied EV in billions would be $13.1 billion. The upside would be faster digital margin of 17.5% and then $14.6 billion. The downside would be slower dinner international rollout with $11.8 billion. Other valuation methods, trading comps applying to peer multiply range of 13x to 16x, EV EBITDA on $900 million EBITDA results in $10.8 billion to $13.5 billion. Sensitivity analysis, WACC sensitivity is shifting WACC by plus 100 BPS, and it shifts the implied EV by 8 to 10%. Terminal growth does the same thing, but it has a different uh BPS. The strategic synergies is estimated synergies 100 to 200 BPS margin lift plus digital scale out an incremental $1.5 billion and 2.5 billion EV. It justifies the strategic bid range. Intermediate checks, terminal value share. Terminal value accounts for roughly 55% to 60% of the total EV and indicates a reasonable balance between explicit forecast and perpetuity. The P&E cross-checked 22x industry PE on $400 million. Net income gives an equity value of only $8.8 billion, which significantly undershoots the EV due to Panera's high growth premium. It confirms the EV EBITDA multiple is the primary metric. And based on the outputs, the strategy is formulated. So with the KKR, the financial buyer, the bid range is 12.5 billion to 4.0 billion dollars EV, and the initial bid should open conservatively at roughly $12.8 billion. The walkaway is $14 billion without clear hand unwritten synergies. Structure is a moderate leverage and insistence on the 10% management rollover to align incentives. Talking points emphasize that digital upside is already embedded in the DCF base case, highlight execution risk in Dinner International, maintain discipline against strategic overpayment, and the strategic buyers is a justified range of $15.0 billion to $16.5 billion of EV. The justification is proprietary scale and cost synergies, procurement, back office consolidation, cross-platform digital integration that KKR cannot achieve. So if we reflect on what we just basically talked about, is that the parameterization confirms that WACC and terminal growth are the most sensitive drivers of value and underscore the importance of KKR's financing structure and long-term operating plan, and it sticks a price based on fundamental value and market comparables, and it protects the financial buyer's downside when competing with strategics who can pay a synergy premium.